guys, welcome back to another video. It's Dave here with Dave G Investing. Just a quick one this time. I wanted to make a video about my most recent trade I made today. I like to make a video every time I make a move, hold myself accountable, let you guys hold me accountable, and you know, it just helps me to think through every trade that I make. So this one's actually a margin trade, which means I'm not buying the stock with my own money. I am buying the stock with someone else's money. That's my broker. They're loaning me the money. And this can be very risky. You can get yourself in a lot of trouble if you buy risky stocks on margin and it doesn't go well. Your broker can basically go in and liquidate your account without any warning. They can just sell stocks for you if they feel that you're now over leveraged. So you have to be really careful about how you do it. Kind of hesitated to make this video just because I don't want people watching me messing around with margin on their own and making big mistakes. But ultimately, I do want to be transparent with what I'm doing and show all my trades, so I decided I will make it anyway. I will show you the criteria I use to make these moves and just talk about the stock that I bought. So if you're interested in this, please do consider hitting like and subscribe down below. It'll really help to grow the channel and let me keep doing this. And with that, let's go ahead and jump into the trade. All right, guys. Just a little overview of this trade I'm making. As I said previously, I have some rules that I just put in place for myself to make sure I don't get myself into trouble. When making margin trades, when investing other people's money, borrowing money and investing it is basically what you're doing. You can think of it taking out a loan and investing that money in a stock. Definitely something pretty risky. So I put these rules in place for myself just over my last few years of doing this to try and keep myself safe. So what I'm trying to do is take advantage of the general upward trend of the markets where, you know, there are down years, but overall the market tends to go up. We can say, being conservative, let's say 5% on average. So on average, the market will go up 5% every year. Some down years will be less. Some up years will be more, averages out to about 5%. So someone's going to loan me money at less than 5%. And then I can take advantage of that and increase my wealth faster. That's what I'm trying to do here in the safest way possible. So rule number one is pretty simple. Make sure that your account can handle a 35 to 40% drop in the markets or in the value of your account without getting a margin call. What's a margin call? That's where the value in your account has dropped so much that the borrower feels you have insufficient funds to justify the amount of money they're loaning you, and they're going to force you to sell stocks, which you don't want to do, because usually when that happens is when your stocks are at a low, and that's exactly the time you don't want to do it. So taking a quick look at this account, I have multiple accounts, but I trade with this one here, has almost $316,000 in it. But is this number we're really looking at excess liquidity. And what that is, the amount of money available to me through margin to borrow. So right now I can borrow $184,000, but more importantly, my account can drop $184,000 without the broker, you know, calling me up and saying, Dave, you've borrowed all this money. Your stocks are not worth as much as the money you've borrowed, and we need to do something about this. So basically, you can think of this as simply, my account would have to drop $184,000 in order for me to be in trouble. And what's my rule here? Well, 35 to 40% drop, we need to be able to handle it okay, because, you know, these big downturns do happen in the markets, as we've all seen. So I need to be able to handle 35 to 40%, personal rule of thumb, and we can currently handle 184,000. So what does that come out to? Well, a 40% drop from 315,000 would be $120,000. We have well over that. Currently, actually, 184,000 comes out to a 58% drop. So what does this mean? My account would have to lose 58% of its value. That's over half of its value before I would get in trouble in terms of margin. And also, just full disclosure, this is what I would like to call my safe account, where I don't hold a lot of those risky volatile stocks. There's a lot of safer funds in here, so pretty unlikely for this to happen, which is what you're going for. You really, really don't want that to happen to you guys. So definitely be careful if you're getting into margins. Rule number 2 is only invest in companies whose dividend covers the interest cost. So I'm looking at my Interactive brokers here. And what loan are they charging? It used to be lower. They've raised it recently because interest rates have gone up. But I'm looking at about 1.83% for the first $100,000 I borrow and 1.3% after that. So let's call it 1.8%. I've probably gone over the 100,000 before on fairly safe investments. So between the two, maybe it averages out to 1.6, 1.7, but we'll say 1.83 is the fee I'm paying to borrow this money. So I need the dividend to be higher than 1.83 so that for every month, every day I'm holding this stock, I'm not losing money and waiting for the stock to go up. I'm actually making money as I'm holding it. So even if the stock is flat, I'm still making money. That's just a rule I put in place for myself. I find for my personal mental health and stress. If you're paying money to own on margin a stock that doesn't pay a dividend and you're down, so every day you're losing more money, it can just be extremely stressful waiting for the stock to do something. So this is kind of a rule that keeps me happy, keeps me sane, and hopefully will take advantage of the overall upward trend that markets generally have. Now, for Qualcomm, it's the stock I'm buying today. Our dividend rate is currently around 2%. So we are, it's not a huge dividend, but it's definitely enough to cover how much we're being charged. In fact, it's a little more. So every day I own Qualcomm on margin, I'm actually technically making money because I'm getting paid more from the dividend than I am paying out for interest. Next rule is only invest in quote-unquote safe companies using margin. I don't want to buy something super risky, something that could potentially get cut in half. I only want to use this in safe companies that are not prone to huge swings of volatility. Now, Qualcomm is on the riskier end of what I would consider safe, but for a few reasons, I think it's currently a pretty safe buy right now. I mean, for one thing, our price to earnings multiple here is 16, which pretty low for semiconductors, that is. Our forward price to earnings is even lower, taking into account earnings growth that's projected into the future. That's down to 11, which is quite low. So for this company to drop in half, the price to earnings would have to drop to about 8, and that's just not going to happen. I can tell you, unless their business collapses, company basically has to be not growing at all for the price to earnings to drop down to 8. It's just not kind of the multiple you would see in this industry. As well as some of these other metrics make it look pretty attractive to me, gross margin, net margin. They're making money. They're not one of these newer companies that are still losing money while they're trying to scale up. Debt to equity is a little high, but overall, I'm kind of comfortable with this company. So that's why I consider it quote unquote safe. Well, one of the reasons anyway. Now let's hop over to the chart. So this is Qualcomm's chart. Going back 5 years, we can see it has done quite well, right? Like it was flat for a while, but it's had quite an upward trend. We did get a big drop from earlier in the year to late 2021 to now. you know, maybe 180s down to 140. So, you know, looking on a 5-year basis, it doesn't look that cheap to you. You might think, well, look, I mean, it's still up a lot in 5 years. This doesn't look that cheap. But what I'd really encourage you to look at is the price to earnings ratio down here, because even though the chart still looks like it's done pretty well, really, that's a reflection of the increase in money they're making. So if you look historically down in this chart, in terms of how they usually trade on a price to earnings ratio, you can see the red line is where we are right now. And I would say we're looking at about, you know, 5/6 of the time it's more expensive than this. This is as cheap as it is the majority of the time. So if you go back in time, look at any time when it was cheaper than this, and how did you do? Well, if you bought it right here on the chart, you're doing okay, right? Same for over here. If you bought it over here, you're doing pretty good. And that's pretty much it for when it's gotten this cheap. It almost hit these levels mid to late last year, which would be around here. And look, if you bought it right then, you're still doing pretty good. So every time it's been at this low level on a price to earnings basis over the last 5 years, you haven't gone wrong by buying it. So that's why I feel pretty comfortable. Also, the RSI down below 50, which is where I like to see it if I'm buying a company like this. So the plan here is that I will hold this long-term on margin. It will pay me dividends greater than how much I'm paying to borrow that money. And I expect in the long term, it will go up. Could it still go down in the short term? Absolutely. Especially in this current environment, we could see it continue to drop for a while. And that's where the dividend comes into play. You're not freaking out paying money to own something you're down on, because then you're at kind of like a double loss, and your stress can really come into play. So whereas if you're making money while you're waiting for it to come back, that's a little bit more palatable to most people. Hopping on over to tip ranks, we can see that analysts have it a moderate buy. There's 17 analysts covering it, 12 buys, 5 holds, no sells, which is nice to see. Median price target is $210 per share. That is 48% upside. So if a year from now, and that's just the median, by the way, the high is all the way up at 250, but I don't try to get greedy with these margin plays. So even if I do half of that, if I make 25% on money that isn't mine over the next year, you can't complain about that. Like that's the goal with these trades, is to take advantage of the general direction of the market in a very safe way. So we're potential upside here is we're hoping for that 210, and we're going to look to make about 25 to 50% safely. Now, when do I decide to get out of it? Well, there's a lot of different ways, but I'm going to definitely keep an eye on this price to earnings chart again down here. If we're doing really well and I see this blue line start to climb back up into the 30s or even the 40s, I'm getting out. I mean, as you can see, if you bought it when the price to earnings was at 40, that'd be like around here. You're not doing so hot. Here, actually, in the chart, you can see that we are still at a decent price to earnings at the all-time highs, and that just goes to show how well they've done at growing their earnings. So great company. Semis are in more demand than ever. I feel pretty safe holding it. I will let you guys know if I add to this position. This was just sort of a little first nibble. Honestly, I would like to see it go down lower so I could buy a bit more. That may not happen. We may sort of be at the bottom here of this macro market weakness, but I wanted to add some on margin in a safe way. As you can see, I can handle 50% plus drop in my account without getting liquidated. So that's the trade. I will update you guys how it is going in the future. If you're going to trade margin out there, please be extremely careful and trade safe.